Tavi, very nice having you. How are you today?
I'm doing great, Mark. Thanks for having me. Follow you on Twitter as well. So thanks for having me. It's a pleasure to be here.
Oh, it's my pleasure. It's my pleasure. It's awesome. I was so much looking forward talking to you because I think you're one of the few guys who really see the big picture. So where are you right now?
I am in Denver, Colorado. What about you?
In Stuttgart, it's the southern part of Germany. That's where they built the nice cars. You know, not Tesla, it's Daimler and Porsche and everything. So we have something in common. We are both mid-20s. Just kidding. We both experienced some currency crisis end of the 90s, and I was 2001. I was in Argentina, and in 1999 there was a currency crisis in Brazil. Did you? Did you make an experience during this time? Do you remember this time? Because we're both so young. And did it do something about your whole investment behavior, about your mindset?
That's a good question. It certainly affected me as an investor today, experiencing, especially my parents having to, I remember my dad had to buy a motorcycle at the time because he didn't want to he had some cash in the bank and didn't have anything else to buy. So he just bought a motorcycle because the value of the currency at the time was depreciating on a rate that we'd never seen before throughout the history of Brazil. So that was a currency crisis, and it was interesting to watch how the equity market did really well during that period in local currency terms until the whole thing fell apart with the currency. So a pretty interesting development that I think actually helped us to have the position we have today. And I think we have a lot of views because of those experiences that we had back in the 90s in emerging markets. But it's I think emerging markets, given the political environment, is very different than developed economies. Certainly, the risk for those crises are much higher, and it's part of the game, I guess. But you had another issue as well, so maybe you can share some of your experience with that.
I'm really grateful as well about the experience, because in the moment when I saw the currency crisis in Argentina, and it was a sovereign default at the end, in 2001, I thought, what the fuck I'm doing here? I have to get out of the country. And it was horrible, because it was so quick that the peso just was not getting accepted anywhere. And so I was under shock, of course, because I came from the safe country, Germany, and from a part where we believe in saving on your account. And I saved my pesos on the account in Buenos Aires, and then it was gone, and the banks were closed. So I was shocked. And actually, this was a trigger for me to start thinking about the monetary system, about currency crisis and bankruptcies and everything. It was the start actually for me, and it changed my whole investment behavior. Back then, I came back to Germany and I went to the bank and I bought immediately. I sold my shares and I bought immediately gold. Argentina, it's like Argentum, it's silver actually. Was one of the wealthiest countries in the last 100 years, and the politicians destroyed it. It's like in Brazil, of course. And I still remember when the banker told me, "Are you stupid? Why do you sell your good shares in these companies from the DAX and the Nasdaq and everything? Why do you buy gold? It doesn't pay interest. It's a stupid rock, and you're so stupid." And he laughed about me. He's not laughing now anymore, of course. He asked me for advice when I come to the bank, which is really raw because I don't like the bank. So, however, we have something in common. Is this the reason why you moved away from Brazil, or what's the story that you live in the US right now and speak very good English, better than any other Brazilian I know, and I know a lot of them?
I live here for a while, and I think being married with an American helps a lot. My wife and we speak English all day long, and certainly the conversations at the beginning of the relationship was pretty rough because of my English skills, but it got better over time, and as vocabulary kind of came in. Yeah, but I moved here because of tennis. I was a tennis player in Brazil, and nothing like a new Federer or anything like that. But I was very into tennis, and realized that maybe I could get very great scholarships coming here and studying in America for really cheap. Actually, I basically was a full ride. And so I did it, not even thinking. I did it, and I wanted to learn English and get my education here in the U.S. And that, I think, opened my eyes to a lot of things. I always wanted to be in finance, and the analytical side of things, but it's not easy to get into that industry. But
Sure.
slowly, I started to do my own work and share with people, and began to work at Crescent and work my way into a portfolio manager position. So it's been pretty great last few decades, and I'm happy. But there's a lot more that I would like to accomplish in this industry. So yeah.
Yeah, awesome. Yeah, I have to tell everybody, I can recommend you guys, and please follow Tavi on Twitter. It's amazing content he delivers every day. The charts, the macro outlook, everything is just a pleasure to read. So you have to follow him. I will definitely put a link in the show notes, of course, and it's definitely worth it. It's one of, I think, the best Twitter accounts when you think about precious metals and charts about precious metals and everything, mining stocks, of course. That's what we're talking about. And but before we talk about mining stocks and gold, let's talk about macro. And I think you prepared some sheets for us, didn't you?
I did. Let me share with you. Can I share with you right now?
Yeah,
Let's
please
do it.
go for it. We're looking
Okay,
forward. Then you
so
guys, you see what he is putting on Twitter every time. Exactly, this the typical Tavi Costa charts from Crescent Capital. That's what you see then. And we start with the US national debt versus GDP.
yeah, so I think this chart is pretty interesting, just to step back and look at the long-term imbalances we have in the world today, especially in the US. But the red line here is just looking at total debt, public debt outstanding, and you can see the two lines. The white line is GDP, and they're both normalized. And so you can see the growth, and the growth in debt has been 3.5 times the growth in economic activity here in the U.S. And it's pretty interesting how this really ramp up after global financial crisis. As you can see, maybe you can see my cursor over here, but this is a massive growth after the global financial crisis, as this line actually declined and then kind of went steady up. And now we have some sort of a divergence there. It kind of picked up recently, global, the GDP, but this started in the 70s, because this was really showing the level of monetary and fiscal imprudence that we reached, especially after the gold standard, after the 1971, and the break of that. So I think that's today what we're seeing with unlimited QE language that we saw from the Federal Reserve and Jay Powell. That for me is just as impactful as we had in the past in the 70s, and given the issues we have in other places. And it created, in my view, a very speculative environment, as we see in equity markets, corporate bond markets, sovereign bonds, yielding negative. So certainly there's a lot of opportunities in the market, but it's some parts of pockets of the market that are very overvalued, and I think in a dangerous spot right now. But anyhow, I do have another
this
chart.
looks like this looks like the end game for me. If you were good in math at school and you had the subject math, and you see a chart like this is chart porn for me, by the way. It's like exponential growth. This is not healthy. This is not sustainable. So where are we right now?
Yeah, it's a good point, and it's something that has been already the case for a long time. You could make the case here at 5 years ago or so, and nothing happened. But truly, this level of increase right here that we had recently, which I think it's well said in this following chart, that took us $4 trillion of public debt increase to get us back to the worst levels since the global financial crisis. So that's the level of economic activity measured by the Federal Reserve. They have an index for that on a weekly basis. Pretty interesting, how this is how much it took of monetary and fiscal stimulus to get us here. And I think it's just showing the dependency of that, especially from the two mandates that I see in the Federal Reserve today, which is to suppress interest rates, especially long-term interest rates. And the second one is to keep equity markets at the valuations afloat. And in my view, this comes at a cost. And the cost is gold and the assets that serve as an alternative for the monetary system, regardless if it's gold, silver, Bitcoin, and the mining space that benefits from that. Should all be the cost of the central bank, which is this global synchronized debasement environment that we see today. But it's a pretty interesting chart in my view as well.
Yeah, and no, I look at crisis in the past, and I think since 2000, since the Nasdaq bubble burst, afterwards we had in 2008 the subprime bubble, the real estate bubble, and now we have the next bubble actually. So every time the central bank had to put more money into the system to keep it alive.
Yeah.
You see, every time it's more and more money. The balance sheet of the Fed, of any national central bank actually, no, the ECB, the Bank of Japan, the Bank of England, and in Brazil as well, everywhere, they just try to get it bigger, 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 bigger to save the system. And actually, I don't think you can save the system. The patience is already dead, I guess.
Yeah, it's a highly ineffective, no doubt. You're absolutely right. And this is just a way of looking at what I call this great disconnect. I think a lot of people have been pointing that out. This is not my idea, but this is just a chart where I aggregate a lot of what we call Crescent macro model, but really is just 16 factors that we aggregate to try to give a score of where we are in the business cycle. But the interesting part of this is that there's two parts of this. There's the valuation factors that are part of this and the macro indicators. And clearly, when I was doing this updating this chart, I was like, wow, it's incredible the difference. And you can see this in the next chart where I stripped out all the valuation factors and added a ton more, going back to all the way to the 1900s. And I see a lot of people talking about valuation saying, wow, in 2000s was much worse with the tech bubble. That's not true. That is true from a market cap base. But when you look at median terms, so not aggregate, median terms of valuations, you can see pretty clearly that everything is at all-time highs in terms of valuations. And throughout history, this is 100 percentile. By the way, it's even higher than this. This is pretty close to 100 as well. And you can see that all this other times in history, throughout history, where the unwinding of these extremes in valuations are certainly not a soft landing. And what you see is a pretty a sharp decline in equity prices, risky assets in general. And I question, will bonds be your asset that will save you from those risk parity strategies that we've seen in the last few decades? I don't think will be the case. So I think there will be a flood of capital towards gold, but we can get into that later. But anyways, maybe you can comment as well a little bit on valuations and what you see there.
Yeah, I think we're in the last stage of a super cycle. I think the stock market is totally overpriced and overvalued. We see actually a melt up, a crack up boom. So the central bank put so much money into the system, and they go, of course, to the real estate market and to the stock market. So I think next year there will be a switch. I guess next year we will see a market crash, and we see perhaps the switch from growth to value stocks. So this is my opinion, but I think we will see a major crash on the stock market because this is not sustainable. Perhaps we can keep it alive for 6 months or 9 months, but at the end, the cracker boom will end, and it will hurt a lot of people because this is not, you see all the points, it's just overpriced, overvalued, but there is no alternative for a lot of hedge fund managers. They have to invest, and that's why Tesla is so totally insane overvalued, because all this money is keep on flowing into the system. That's the only reason.
Yes, and there's a fallacy in my view, which is seen in this chart, where we hear a lot that interest rates justify the valuations, and they do to a certain degree. It's part of discounting for cash flow models, but you also have to consider the fact that with the macro situation being so severely impacted recently, how do you see a growth going forward for a lot of companies? And that for me is where when you calculating the present value of an asset, you have to consider that. But regardless, if you look at the median valuations today, which I think it's important to go back to the 90s, just because that was something that is an argument that we hear a lot. Sure, valuations are high today, but even in the 90s, they're very high, but interest rates are much higher. But look at the residuals. So if you just do a regression line here and you look at the residuals between the price to book or any of those the 4 metrics in the medium terms relative to 10-year nominal rates, you can see that the spread between that and the line of the residual is never been more stretched. So certainly the valuation factor for me is something that is being ignored in a huge way in the markets today, as this belief that central banks have the markets back for forever. And I'm not sure if that's going to be the case. And I actually I strongly believe that that's not going to be the case in the following years, and I think it's a dangerous game to really support your thesis in those things. As we've seen throughout history, central banks are not capable of avoiding the collapse of business cycles, and I don't think this time will be any different. But that's
Exactly.
just my view.
No, that's what I think. If you look at the past, central banks never avoided a crisis. They never could save the system to not get into a crisis. So they always tried afterwards to repair it, but made it always worse. In 2000, when the Nasdaq bubble just burst, what did they do? They put more money into it, and they tried to stabilize the interest rates, but it wasn't possible. The interest rates got lower and lower, and they were so cheap, so people could buy real estate in the US, which they couldn't afford actually, but money was cheap, and they created a second bubble. So actually the central banks create one bubble after the next. And they're always like, okay, we are the fire department. We try to save you guys, but at the end, they make it worse. That's my opinion, because after 2008, they did the same. More money than ever before, and lower interest rates, historic low interest rates. It's like 0% in Europe with the ECB since 2016. This is the lowest interest rate we ever had. The same in the US. I expect negative interest rates next year in the US and in Europe, of course, as well. In some countries who already have it, Japan, Switzerland, and more central banks will go this way. They will never raise the interest rates again, because if they would do, the stock market would crash, the economy would crash, some big companies would crash, and of course, a lot of countries in Germany and Europe would go would fail, like Greece or Italy or Portugal.
I'm with you. Here's a chart that I did yesterday, actually looking at corporate bonds, because we're talking about a little bit of the risk parity situation where it involves bonds and stocks, but this is just looking at corporate bonds here. And you can see as well this the first time in history where when you aggregate, just look at actually its investment graded bonds relative to 10-year break even rate. That never happened before. If you look at CPI, I've used this chart before, it is negative, but I think it's even more relevant when you're looking at the market expectation of inflation rate in the following 10 years. And pretty interesting that now that's in real terms, it's now negative. What is the alternative for any investor today? And it goes back to the gold thesis again, but it's astonishing how, matter of fact, when you look at the amount of leverage in the system of the corporate side of the economy, it's also very steep. We are at all-time highs in terms of total debt to total assets in the equity market here in the U.S. And I think it's somewhat of a product of what we're not somewhat. It's certainly a product of what we're seeing in terms of the policies from central banks in general, but also how many companies, zombie companies that would never survive in the 70s or 80s or 60s, given the losses, the constant losses of quarterly in terms of their businesses, and I view this as a real problem. And again, it goes back to this dependency of central banks to keep this afloat, where I think it's only going to continue to see a rise in balance sheet assets here in the Federal Reserve, at least going forward, globally too. But
definitely,
And I was lucky to find this a ratio. There's a few on Bloomberg. They can calculate the performance of risk parity indices. I'm not sure if you've ever seen this, but it's pretty interesting. And we've been talking about risk parity. Well, let's look at gold relative to risk parity, because the whole idea is that investors will get out of those two asset classes, bonds and equities, and maybe perhaps get into precious metals. And we're seeing this performance of gold relative to risk parity indices begin to outperform. And it's I think that uprise is just in the early stages. We're going to see much higher than that. Back in the 70s, a lot of the large pension funds used to invest in gold. Now it's out of favor. What a timing to be out of favor when this level of monetary dilution that we're seeing. So pretty timely in my view, and opportunistic for us that like gold in my view as well. And I don't know if you've seen this chart that I had in the past, but this is a technical problem in my view that is happening in the treasury side of the market, where as I said, we have $4 trillion or so of debt issuance since the pandemic started, and a lot of that, about 70% of that, came from the treasury bills. So a lot of those are short-term maturity bonds, and when you accumulate with all the others that we've had so far, in terms of other tenors in the side of the treasury market, pretty clearly you see that about $8.5 trillion of treasuries will be maturing by the end of 2021. My question is, who's going to be the next buyer? Because in the red line here in this chart, you can see that the foreign holders have been declining their participants in this market, while the Federal Reserve has been increasing its side. So it's debt monetization 101 here, and I think that that's just a trend that is irreversible and will likely continue here going forward. I think that those two lines are dangerously converging, and again, it all leads to gold.
Yeah, exactly. And we're heading for a planned economy. The central banks will one day own everything. They buy everything. They start in buying bonds and then start buying shares, ETFs, everything. So we're heading to socialism, I guess. And this chart just proves it, because nobody else wants to buy them. Because if you think, I think $18 trillion of bonds are with a negative interest rate, and it's getting more and more. So who wants to buy this shit? I'm sorry for my French, but the central banks have to buy. The same in Europe with the ECB, the same everywhere, all over the world. So we're heading for a planned economy where perhaps the central banks will own everything one day. We'll see.
Yes. And also the commercial banks in the US have been forced or instruct, whatever you want to call, to buy those treasuries. Today, they lend more to the government than businesses and households. And it's again goes back to this idea of, if there's no lending to those parts of the economy, how do you fund organic growth going forward? I think this is all,
the problem is, exactly. The problem is the growth is very weak and the debts are too high. The debt is rising faster than the growth, and this is the killer for the whole system, actually.
Certainly, yeah. The debt burden is becoming a problem here, and but going back to the chart, before, where we had the central banks participating more and more in the treasury market. Well, that means their assets are increasing, and therefore that's the blue line, but that's globally. So now we're looking at the largest 8 central banks in the world. This chart actually needs to be updated because it's now over 26 trillion now. It's pointing to 24 or so. So that's $2 trillion off, by the way, but it's still a very valid chart because it points to me, it's one way to measure gold. I mean, it's hard to find what's the intrinsic value of gold. I think it's somewhat what the level of monetary dilution has been. And sure, not all of the central bank assets are monetary dilution per se, but I do think that technically, this is an environment where gold should be at least, near the 3,000 levels today. It's also interesting that the two charts, if you look at the axes over here, you can see pretty clear that in the same, they're just different in the zeros. So, but they're in the same scale pretty much, and it's one way to value gold, in my view, as well. I think we're headed way higher than where we are today, and if that's the case, I think there will be, as I said, especially in the mining space. My goodness, I think that would be incredibly positive for those businesses. I think we can get into that soon here.
So, what is your goal for? What is your goal for your price target for gold, for example, in 12 months, in 5 years, and in 10 years?
I know a lot of people love to say those things and say, "Wow, I think it's 10,000, 20,000." I really don't have one. I really have a moving target for gold. I think it would be fair to see it at close to 3,000 soon. Somewhat soon. But does it have the potential to go to 10,000? Sure, it does, and I wouldn't be surprised. But we would have to see more monetary dilution going forward as well to support that. And I think that there is a case for that. But it's. I think I might be setting myself up for failure if I come up with a number. Who knows if gold goes parabolic for the next 2 years, I'll be out of my position, but right now I think that gold is extremely cheap given what's going on. And so I'm pretty open-minded about, I'm not, I would say I'm not the gold bug, usual gold bug. I see this as a macro trade. I really do. This chart right here is just a way of looking at, in my view, this largest supply and demand mismatch that we've seen in the history of gold. We were just talking about all the reasons of why we should be buying gold on the demand side. Look at the supply side is even worse. There hasn't been any discoveries in the last 3 years. And when I say discoveries, is 2 million ounces above of gold. And literally none of those. The exploration budget has been a declining trend for a while. So we've had a situation where conservatism in the industry of the mining space is really going to have an impact on supply that is likely to remain constrained for a while. As we all know in this industry, it takes 5 years. You've got to commit today to have 5 years of mine working, operating, if everything goes right and there's no geopolitical problems. And all the permits come easy, and it's not that easy. We've seen this throughout history. It takes some places 7 years for you to get from A to B. So I think this is going to be another issue, especially in the silver market. Silver market is even more impacted. Copper market is impacted. The whole commodity space is impacted by that. But anyways, this is a big deal for me.
Yeah, and the trend was even worse because in the last 10 years, we had a bear market. Actually, since 2011, there was a bear market, and companies were very, very carefully what they did with their money they had left. So there was no new big discovery, like you said, and they were not ready to invest too much money in new fields and everything. So yeah, that's the reason why the market is getting smaller and smaller.
It's it's a scary scary world for those guys that are looking to expand their businesses and don't have any new discoveries. And the market will be hungry very soon here. Those big miners will be hungry looking for new deposits.
Exactly.
This is sort of the same chart as above, but I should say the same idea. It's just looking at the CapEx cycle for the mining industry for the top 50 miners in the US and Canadian exchange. And you can see here in aggregate terms in the red line, that's the CapEx. It follows the gold prices pretty closely throughout history, but there's a divergence now. And I think this divergence is in what you just said, is this reputation of being such capital destroyers for so many years, and forcing them when capital really dried in this industry because of the bear market in the last decade. It really made those guys to really cut costs. And one of the things, the impact has been seen in the CapEx cycle. This is the first time we've seen metals actually taking off, but CapEx actually not improving. And it makes sense that as metal prices increase, those guys get optimistic. They want to spend more money. It makes a lot of sense, but not this time around, where I think it's, again, absurdly optimistic for the whole industry. And it's just, this is just to show the 20 years of being capital destroyers, 25 years. And now recently, what I call the new era. And I don't want to say it's just myself. There's plenty of people making that call as well. And I agree 100% with that. And it's a new era for precious metals. It's a new era for those companies that are actually growing fundamentally and should be the new growth stocks in this environment. Where there is no yield, where valuations are extreme everywhere. But hey, here's an industry that's actually growing like never before, and with valuations that are cheaper than ever before. So this is really a very interesting setup.
It's a no-brainer. I know I've got a mutual fund and we invest heavily in mining stocks the last 2 years because I think this is the future. Next 10 years will just be crazy because the valuation are so cheap and surrounding is perfect. It's perfect. The central banks print money like crazy and you need to have limited assets in your portfolio, gold, silver, and everything else which is limited.
Yes, and the issue with allocating money in the industry, which I think is an opportunity, is the lack of some of those places have a lack of liquidity. Well, the industry is worth about $600 billion, while Apple is worth 3.5 times the size of the whole industry. Just one company is worth 3.5 times the whole industry. The only industry that should benefit from all this. So the asymmetry there, I think it's you know, it's still poised to prove it to be correct here, and then we're going to see an upside for the whole industry in aggregate to move higher. But liquidity will come in and will make those markets as liquid as they used to be probably in the 70s. It's hard to quantify how liquid they were. Home state capital was pretty liquid back in the 70s, but it's hard to find more of those miners back in the days and data that is available. But it's I think it's going to go back to those times in my view. But yeah, that's all I have. It's about 8 charts.
Awesome.
I can go
Awesome.
on and on, but
No,
yeah,
Tavi, it's awesome. We will definitely have you back in the show because I love your charts and they're so great and easy to watch actually. And I'm looking forward for the audience what they say about your charts. So you made a pretty good case for precious metals, for gold, for silver, for mining stocks. There are a couple of questions I have. You know, this show will be called Investing During the Pandemic. No. So what do you think? What impact has the pandemic, has the coronavirus on the precious metal sector?
Well, there has been a lot of impacts in the more micro side and the macro side. Obviously, the micro side, I think it's been, you know, it's been difficult for those companies to operate in the pandemic environment. Number one, restricting the production of gold and silver. We've had, you know, gold, especially a silver actually production fall of about 30% this year. And that has nothing to do with metal prices. Metal prices are rising, but you know, they should be increasing their production. You should be excited about this. But the pandemic's also forcing them.
When I might interrupt you, do you think gold is a big winner through the corona crisis? You think gold surged in the price because of corona or because of the actions of the central banks and the governments all over the world with the stimulus packages?
I think inevitably we're leading towards a world where the surge in debt was again inevitable, just because of the dependency of that in financial markets, and any collapse in equity markets would force the central banks to do what they did. The point is they were forced to do, you know, an enormous amount of stimulus, and something to the degree that we have only seen throughout wars. And again, this is not done yet. I mean, who knows if we're going to have another lockdown, another round of massive stimulus, which is very likely, obviously. But what are you going to say?
No. I think we will definitely see another lockdown. In Germany, we just have the second lockdown, and they just told us till Christmas. Now, yesterday they said it's till mid of January. So yeah, lockdowns will be around us for a long time, I guess. Yeah, we will see. It's a difficult topic all over the world about lockdowns and vaccines and everything. So. Do you think we're headed for a new bull market, or we are already in a new bull market for precious metals and for mining stocks?
I do, and I scared a lot of people. Since July, we've had a pullback in gold that was even larger than we had in the March, about 14% decline. But you know, in my view, when you look back in the last bull market from 2001 to 2011, I believe we had, last time I counted, it was about 6 times that the gold market declined about 10% or more, including one time that arguably was the end of the bull market, but I still include as part of it, which is a 28% decline in 2008. But it, you know, business came back as usual later on, and the market resumed its bull market and went up throughout the whole period about 650 to 700% from 01 to 2011. So those are opportunities, and the funny thing is there's always a new narrative that comes out as the new reason why you shouldn't be buying gold. There's always a new guy saying that this is not the time to buy gold, and this is a time when you have to do your own homework and look back, you know, stand back on that big picture charts that I was showing at the beginning of the presentation. And think, I mean, this is not going to change. Vaccine is not going to change the environment. You know, look back in 2019 when the economy didn't have the pandemic going on.
Exactly.
What was happening? Well, I mean, the labor market was already turning. We had, earnings was already turning as well. We had Japan's GDP was negative in the fourth quarter of 2019. This has absolutely nothing to do with the pandemic back then. So it's the level of indebtedness that is like you said initially, that is becoming an issue, where more units of debt to create less units of growth or economic growth. So it's a global synchronized based environment, in my view, where inevitably gold will continue to move higher. It's unavoidable.
Exactly. And we already saw in 2019 there was a recession, definitely coming to Europe. We had in Italy already a recession, and in South America as well. And the thing is, the central banks already started the whole printing many insanity in last year. In 2019. Remember, in September, the Fed had to do the repo program in September every night, like a few billions of dollars to keep the banking afloat. So they already started printing before the Corona crisis. So this is, it's very interesting, but most people don't know that. And that's why I try to give the people financial intelligence so they see the whole big picture. So we both agree that we will see a new bull market on precious metals, on mining stocks. We both agree that we will see new record levels in the gold price and the silver price perhaps as well. So do you think there is any chance that there will be another gold standard in the future, so that we have a backed currency? Because we both agree, if you look back in the history, it all started in 71 when Nixon said, hey, the dollar is not backed anymore by gold. That's when all the debt levels raised like insane, all over the world. You look at any balance sheet, it doesn't matter which country or which central bank, it just started in 71. So what do you think? Is there any chance we go back to a backed currency or to a golden standard as well?
Yeah, all those policies, including confiscation of gold and all that, I think it could happen. I think those are all real possibilities in the near future. And I shouldn't say near future. I should say in the future. That the issue is we need first the turbulence in the FX market to see that, or the inflationary environment in order to see that kind of policy. I don't think we have seen that yet. I think we're in the beginning of that. Maybe in 3-4 years, I don't know how fast is going to be the increase in gold, but maybe we're going to see this in the short or medium term. Usually gold bull markets tend to last about 10 years or so. Maybe this time will last a lot longer, given the imbalances we've never seen before. So I think will all depend on the actions that we're seeing and how the improvement in the economy going forward. And if we're going to start seeing organic growth, that's the biggest risk for gold. But again, going back to your question, I do think we're going to see some degree of that at some point. But first, we need to see the problems unfolding, and I don't think we've had enough yet.
Okay, that's very interesting. So you think a confiscation could be possible as well? Because I think as long as we don't have a gold standard, the governments and politicians don't even care about gold, because it's such a small valuation of gold.
Yeah. So what I was saying is it's a good point what you said about the confiscation, and the relevance of gold is very different than what used to be in the past. And in my view, a lot of investors are worried about investing in the mining space today, with that thought that we're going to see confiscation, and especially in the mining space. And I think that's way too down the road. I think we've got to see first a severe decline of fiat currencies valuations, and then we're going to see probably somewhat of a gold standard, sort of way back to that. And it doesn't need to be gold standard, but somewhat of a back to prudency that we haven't seen in a long time. And so it's going to have to happen at some point. When that happens, I think then the confiscation thing could be an issue. But it's important because when you look at the global economy, some of those economies are in different parts of that confiscation issue, and maybe Bolivia is in a different place than the U.S. or Colombia, who knows, or Brazil. And so it's important to be diversified across very different jurisdictions, so you can avoid that type of geographic issue where confiscation happens in one of those countries. But I wouldn't let that, really, not allow you to invest in those companies. I think there's still a great opportunity.
Sure.
They're not priced for that at all, for the opportunity I had, in my view. And you're certainly paying already for that. Risk is certainly priced in the shares of those companies, well priced in. I mean, it's what is not priced in is the fundamental growth and the potential for an improvement in those companies going forward. I think that's what's interesting.
Definitely. Another problem is we both know that investment banks like JP Morgan or Deutsche Bank heavily manipulated the price of gold, silver, and actually everything. Yeah. So you think this will still have an impact in the future? They will still do it because they paid billions of fines, but I think they still do it. They still manipulate the price for gold, silver, and everything with paper and so on. So what's your point on this?
I have an interesting take on this, because I think it's certainly something that happens. But at some point, what's going to happen is that, given this degree of devaluation of currencies all over the world that we may continue to see in the following months and years, what's going to be relevant is going to be the quality of reserve assets of those central banks. And the quality goes back to what is the best asset you should own to make your currency not only stable, but improve the level of strength of that asset. And in my view, the only asset that falls in a category of fitting and improving the quality of reserve in international reserve assets would be gold. I mean, it has to be gold, and it's the only place that it has the liquidity to afford that level of capital in terms of central banks. So I think central banks will actually, you'll see in the margins some sell-offs here and there, but in the net basis going forward, I think they're going to realize that and start buying more.
But they already
gold.
do, Tavi. They already do. Since 2008, you see a lot of central banks who buy more and more gold than ever before. China, Turkey, Russia. Yeah. They already know what's going on. That they don't trust their own product anymore, like paper money. So they start buying the real stuff.
And it's a good point what you said, because there are some issues when those happen. Sometimes in the short term, which is sometimes they're forced to sell. Turkey was forced to sell a little bit of gold recently. And why? Well, they have issues with their currencies, and
exactly.
There's no way around it. And so it hurts the gold market in the short term. But is this for a person taking the big picture here? I mean, this is an opportunity. It's a window. That ECB and the Federal Reserve and other places are going to be forced to do it at some point, especially if the U.S. Has issues with challenges of losing its reserve currency status, which I don't think it's going to happen. But if there's any challenge type of thing, and I think that's possible to happen, and I think any other currency that is looking at becoming one of those, euro or the British pound, not the yuan, but some other places, I think that all of those will be looking into improving the quality of the reserves, and gold would be there to accommodate that. And,
exactly.
And that's the important part.
Yeah. So let's move on to silver. You think silver will outperform gold in the next couple of years?
I hope so. I think it will. And I really do. And I do, because in a healthy environment of gold, silver does outperform gold. And that's just the nature and extent of the bull markets in the precious metals. Is silver is a much more volatile asset. You're paying for that. You're paying for that premium of appreciation, and it should be. Silver, in my view, is the cheapest metal in the world today. I've said this before, but my reason for that is because if you think that gold is undervalued, not only relative to the demand side, but the supply side, silver is even worse on the supply side. We've had so many mining companies run away from silver businesses in the last few years and decades, and I think that's the product of the problems that we had with the bear market of silver, which was way more severe than we had in the gold market. Yeah. Gold really began to turn into 2015, not silver. Silver had it took silver a while to really begin to turn, but now, it's especially when you ask me about this, sell-off in gold recently, pretty interesting, the resilience of silver relative to gold in the last few weeks or so. The gold to silver ratio, actually didn't move as much as it did back in March. In March, that thing just spiked up and reached record highs. Not this time. It's been pretty stable. So I think it's very encouraging of what we may see.
Yeah, I'm super bullish on silver because you actually use it in the industry, everywhere you need it on the phone, everywhere. It's just incredible how many use cases you have for silver, That's why I'm super bullish, and there is less silver in the ground, and available. So this is why I'm very positive. Do you have any price target on silver for the next 5 to 10 years?
Well, I think it's going to be well above the $50 or so.
Yeah. Okay. I agree.
And if that's the case, there's some mining companies that already make a ton of money with $30 an ounce or $25 an ounce. Can you imagine if that goes to $80, $100 an ounce? I mean, that's very doable. Yeah. So I think that the next leg up, we'll see a surpass of the 30s, and then maybe another consolidation, and then boom, and then it's going to be just all-time highs, and that's it. That's going to be just after it breaks the all-time highs, it's going to be there for a while, in my view.
Yeah, I think so. The same, because the central banks will print more and more money, and the people just look for an asset which protects their purchasing power, and then they will, I guess, will go to silver as well. So let's move on to mining stocks. Mining stocks, in this case, there will be 10 or 100 baggers, I guess. So which mining stocks do you recommend?
Well, so I have, it's different. So I like Newmont, I like Barrick, I like Kirkland. All those companies are doing really well.
Majors, yeah.
I think that the whole industry will do well, but those companies, for the people that are not following the market, I think Franco-Nevada is a good royalty business. Sure. But I would say Newmont would be probably the best mining company out there, in my view, by far. But obviously different business than Franco. Royal Gold is an interesting business too. Agnico is an interesting business. But I have to say that at Crescent, we're actually more involved with the exploration names.
Sure.
And the reason I say that is because it's not contrarian to buy gold today. I think a lot of people agree with the thesis. Not enough people, but some people would agree with us here in this presentation. A lot of people would agree. But I think that there is certainly an adverse for the speculation, I guess, type of names in the exploration side, which certainly are seen and are speculative. But we did in a partnership with Quentin Haney, and our goal is really to act as activists, in those names, and hopefully offer a trigger to those guys to really be able to succeed in those projects. And that whole idea of that discovery curve that I showed, our goal is, if that discovery curve begins to tick up, hopefully we are the ones that are involved in those names that have been able to find those new discoveries. Really, that's the goal of Crescent in the following years. I can give you some names.
Please do. The audience will love it.
I think that there's a very interesting name. Again, those names are very illiquid. They're very interesting, but they're very illiquid. And we own a significant part of those companies, from 10 to 20% of stake.
Wow.
But one of them, my favorite, is SK Mining. And I think the ticker is ESK in a Canadian venture. It's probably the what we call the SK2. SK Creek used to be it was a company maker for home stake mining, and then when Barrick bought them out, it was one of the best mining deposits we've had in history. And I think we're on the way to find SK2, and that's SK Mining is in that area. There's also other companies such as Condor Resources, an interesting one in Peru. They have a land package of a lot of projects that are interesting in the silver and gold side. We have another name in Mexico that is interesting in the silver space as well, Defiance Silver. It's an interesting name. And there's another one that I think it's going to be a home run, in my view. It's already been a home run, is Newfound Gold. And it's that one is probably going to be one of the largest discoveries of gold in North America or in the world in the following years. And I think we're well positioned there as well. There's GBM Resources in Australia. I think that's an interesting name. I'll give another one that is in Bolivia that I think it's doing a tremendous job and very successful drilling results that we're seeing is El Loro Resources in Bolivia. We're not scared of going to those areas if they're priced accordingly with the risk of those jurisdiction risks that we have in Colombia, in Bolivia or Peru. But this could be potentially a massive deposit. So we're certainly involved with a lot of those names in those areas. And but it's nice to find, SK Mining is my I think it's my favorite just because of the safe jurisdiction in British Columbia. But also, just a well-run company with a lot of, we have an expressive activist stake in that company. We've been helping them a lot in the technical side with Quentin Haney. I'm not a geologist. This is a macro trade for me, but our team that we put together to work with those companies is the goal is to really offer the capital and tell the story, but also be successful in the drilling rates of those results. And I think we'll be proven right in a lot of those names. The goal is to own about 40 to 50 names and hopefully have 10 to 15 names that really succeed in the next few years. We're very selective and hopefully I gave you a few, but those are my favorite names right now.
I like them. I've got 2 of them in my portfolio as well, so I'm happy to hear
really?
them.
Which one?
Finance, for example, Silber. Yeah, I like them.
Yeah.
I like them. So how many % would you or should somebody invest of his net worth in mining stocks? Is it like 2%, 5%, 10%? What do you think? What is the right number?
Well, that's a tough question. I think it depends on your risk profile. I think both of us, we like to call ourselves young here. So I would say for young guys, it's a significant portion of my portfolio today.
Okay, how much may I ask?
Yeah, I mean, but I'm young and I really believe in this and I'm willing to take the risk because I'm for me, this is a very, very high conviction trade. So I have more than 30, 40% of my net worth in mining space. Cool. That doesn't mean that's what we have in other places. So in the Crescent, we have 1/3, 1/3, and 1/3 in terms of the global macro, which is we have a few plays in the dollar, which is a few plays in terms of major devaluations in currencies, especially the yuan and the Hong Kong dollar. Those are very cheap ways of playing. They don't cost us a lot, but the size of the trade is about 1/3 of what we have. And then we have another 1/3 in the mining space, which is 95% of the exploration side. And then the other 1/3 would be shorts in the market. So the long short strategy is certainly doing what we like to say, which is buy gold and sell stocks. I would like to say, when you look at the ratio of gold to S&P 500 ratio today, in November, it was the worst decline in 37 years. Yeah. And I think that's an opportunity. I mean, the macro conditions here haven't changed at all. So
it's a no-brainer, actually. It's a no-brainer. So what do you think about uranium?
I don't have any uranium, and I don't think it's a bad play. It's just I don't think I have enough time to really understand that market. I try to just have a simple view and maybe have a few simple positions. But my understanding is that's a lot more in depth than that, and it requires a little more understanding. Just like the mining industry, I wouldn't mess with the exploration side of the industry if I wasn't so involved. I would suggest anybody to go to the bigger names, or pay for someone to do the job.
Like Crescent
or yourself, yourself. I think that's fair. That's the right way to do it. But do it yourself, unless you're a geologist and you understand the industry well. It's very hard. It's not easy. But the same goes for uranium and other parts. I mean, I think there's opportunities in the whole commodity space, by the way.
Yeah, exactly. I think it's a once in a life opportunity, actually, because the commodities are on an all-time low and there is so much potential. And there are also, I think for the average Joe, I would recommend an ETF. There are good ETFs out there or mutual funds or something, all the big names like you mentioned. mentioned already. So, but there are also risks in mining stocks. We have to mention that is, of course, geopolitical risks, of course, or if you're in Venezuela, you get perhaps confiscated or something, if there's socialist government, it's really, or somebody doesn't find anything on their field, it's always possible. So many mining stocks went bust in the past. So it's not a safe game, but like you said, if you have 50 companies or 40 companies and 10 make it, you're done, because there are perhaps 10 or 50 backers. So but we talked about the stock market already, about equities. So you are very vocal actually about the stock markets being overvalued on Twitter and everywhere. So what's your outlook for 2021? You think there will be a major crash like I expected in 2021, or what's your point on this?
Crashes are hard to expect them, but I do think that gold will begin to outperform equities. And I think there is a very, very valid case and high probability of a crash.
Yes.
You need a trigger, but there is enough potential triggers in the space today. There's almost like two tail events very possible here that are, one is a deflationary bust where we have a major lockdown again or something like that can create that, like we saw in March. But there's also the other one, which is on the other side, which is the inflationary one. We're seeing commodity prices begin to rise. My view, we haven't seen inflation yet because commodity prices have done nothing but go lower and lower for the last decade, and some of the places even a lot longer than that. And I think that that's changing. We have copper now at a 7-year high. We have agricultural commodities breaking out and starting to move higher, 10% up on a year-over-year basis. We got gold and silver higher in the last 2 to 3 years. So everything is kind of moving towards that direction at the same time as the Federal Reserve and the governments keep pumping liquidity here. So, there is an opportunity in terms of the inflationary trade as well that could, in my view, when people ask me, look, you're a gold investor, what do you think about inflation versus deflation? Honestly, I don't have a strong view on that as much as I think an equity investor should have. I mean, if there is inflation, you cannot justify the valuations we have today in equity markets. So I think that's a much more relevant question to those guys that are buying today tech companies at 50, 60, 70 times sales. How do you justify that if you have 3, 5, 4, 5% inflation at some point here? And I'm not even talking about hyperinflation because I'm just talking about just a higher level of inflation that we've had, normally throughout other times in history.
Yeah. I think the central banks will not allow it that there will be a crash. So that's why they always pump more money into the system. We will see. So what's your take on bonds? Because a lot of people in Germany, they own life insurances, and we all know they are invested in bonds. So you think the bond market is the mother of all bubbles, or what's your point on this?
Certainly are, and the problem is, at what point the Federal Reserve and central banks in general will be able to continue to suppress rates at these levels, and I think that they might be able to do it a little longer, but and I think we might see, as you said earlier in the conversation, that we might see negative rates here in the U.S. But for the gold investor, the important side is the real rate side, and I do think that inflation expectation will be running hotter than nominal rates. And I think that's the bottom line for us. But nominal rates might run a little higher. And that, when you ask me what's going to happen with equity markets, well, that's a big deal. That's a huge deal for equity markets. If nominal rates are at 3%, for instance, you have to get a multiple compression from the equity market side if we go to those levels. But gun to my head, I don't have any bond trades anymore. I used to have a trade that I might put back again because it hasn't worked in a while. We cash out of that trade, and it hasn't worked recently. And I'm starting to think that it could work again, which used to be Bill Gross's trade back in the day, which was buying treasuries and selling short German bonds, where the interest rates of those two countries tend to converge as you see the development of unfolding of a decline in the business cycle globally. Yeah. And we had this was a very, we had other bad trades, but this was a very successful trade for Crescent for a while. And then we got out of that just to free up capital to do other things. as we saw more opportunity.
Yeah.
And luckily, this thing kind of came back to us, interesting levels again. So we were considering this idea one more time, but I don't know. It's been so many opportunities in the precious metal side that all of our capital has been going there.
So would you invest into real estate right now?
I don't. I mean, I think that there is, again, I think that the valuations, commercial real estate, I'm not an expert in that side of the market, but I think that I don't want to be the guy paying for the bill here in terms of interest rates. I think that there is a case. I would never buy bonds naked, meaning I would never just buy treasuries on their own. I would certainly hedge that against something else. And the same, in my view, that's a long duration play that you're doing by buying real estate. And if you have interest rates going up to 3-4% because of a major inflationary environment, because let's say there's a disruption in the Middle East because of oil and who knows? I mean, those things could happen. No, go ahead.
No, the black swan can happen all the time. And you saw Corona was something like a black swan, and then everything changes.
And how do you sell your real estate? I mean, it's not a very easy asset to sell. I mean, it's not as liquid as you would think.
And look at the commercial real estate. It's done actually. With every lockdown, it's done. H&M, Zara, all these retailers, they just closed the stores. Starbucks, they closed everywhere. So if you own those via a right something or via a mutual fund or ETF, or you're the direct owner of this building, you're just screwed.
Yeah. In one side, I do think that at some point, the economy will go back to normal in terms of, and I'm just talking about the pandemic situation. And, I don't think we're going to see the same level of working from the office that we've had before, but certainly not so much as we see, at least our office is going to go back to normal as soon as the pandemic is over, I think. And I think all of us would like to be working from the office again. Maybe not all days of the week. We might have some sort of hybrid.
It will change. It will definitely change. But the thing is, perhaps we have a vaccine against COVID, but we don't have a vaccine against the collateral damage the lockdowns did. People who are out of business, people with no job, with no savings. This will cost us trillions of dollars actually, and it will definitely take some time for us to repair all this collateral damage happened and made by politicians, and that's really, really bad. And but we will never go back to the old world. We will never work every day in a big office. We will never travel like we did the times before COVID. So to wrap it up, Tavi, my favorite topic, digital gold, Bitcoin. What's your take on this?
Oh, I like Bitcoin. I think Bitcoin is having a silver moment that it had, but not everyone in the firm, Crescent, will agree with me there, and that's fine. I can do whatever I want with my personal capital there. But
do you own Bitcoin private as personal?
I did sell a big chunk recently, and I put back in silver recently. But I like it. I own it. I used to own a bigger percentage before. It wasn't never as big as my mining positions. I do think that the potential for Bitcoin and the potential for the mining space is very similar in terms of the upside. And so, for me, since I'm very in this industry, I'm working very closely. I do end up seeing, I think, hopefully more opportunistic deals that make myself feel excited to invest with my personal and clients' money. In terms of Bitcoin, it certainly is a tool, or it was built in a way to fix some of the issues in gold, in my view, where you don't really know how much supply you have of gold. We just said that we have haven't seen 3 years of discoveries in gold. I actually believe that's very, very true, but it's hard to measure fake bars versus true bars, or so Bitcoin fixes that issue. We know exactly how many Bitcoins have been mined. Can be mined.
Portable,
when people talk about forks and other issues that could be seen as dilution, that's not Bitcoin anymore. There's a lot of, I think that the Bitcoin itself is, it has already a network effect that it's going to be very difficult to disrupt. And it's important to see the trend of following base in Bitcoin even after the bust in 2017. I mean, just look at Twitter. People are just evangelical about Bitcoin, like I've never seen before, even worse than gold. So, I don't think those guys are going anywhere. And that's mostly the guys, the younger crowd that really likes to buy Bitcoin. Now, there's something that I disagree that has been said in this industry in the last few days, especially saying that, Bitcoin is stealing, gold's inflows and all that. That's not true at all. I mean, Bitcoin increased its value by about 200 billion in the last few months or so, and gold lost about $2 trillion. So the inflows in Bitcoin can only explain, in a perfect world, 10% of the decline in gold. So, that is just mathematically wrong and invalid thesis. But look, I think that can Bitcoin surpass gold one day? Sure, it's possible. Okay. I still think that gold is ultimately, it might have some advantages over Bitcoin in a few aspects, being more of a real tangible asset, I guess. And so I don't know, but I like to own both. I think both have opportunities. My only concern is that the same way you shouldn't be adding to silver back in July, you shouldn't. I think you should. It's not the time for you to be adding to Bitcoin right now. I think that the time to add to Bitcoin was when silver was booming and Bitcoin was not doing anything. And then, and then guess what? It reversed. Bitcoin began to rise and silver just went lower and lower. And so I see the same pattern again now for silver and miners. So that's just it. But I like both.
Yeah. I had another guest on this series. It's Michael Saylor from MicroStrategy. Perhaps you know him. He bought with his company $425 million worth of Bitcoin, and he made a strong case against precious metals and against gold. But I said the same. I like both, and I like to have a diversified, balanced portfolio and have different assets in my portfolio. So how much or how many percent of your net worth would you invest in Bitcoin?
Well, I feel comfortable putting as much as, let's say 20% or so. That's my level of confidence that I have. I've had that before. I've had maybe a little more, maybe closer to 30 at some point. But mining space, I'm more of a guy, and I'm okay having large positions in one thing and watch it carefully. That's sort of my style. I don't like to diversify as much. Different from my clients, right? The clients, it's a little bit different. I think I manage the money a little bit different in that way because my risk profile is different than what the mandate of the fund really is. So, but that's just the nature of the business. But for myself, I'm okay having a large positions. Let's say SK Mining is a very large position for myself. But there are other mining companies that I'm also significant shareholder for what I have of my net worth. And I don't know. I like it. I think Bitcoin has its own spot in a lot of portfolios, and unfortunately, I do think that what Michael Saylor, I think he's a very smart guy, undoubtedly, and also has been doing really well recently, especially with this rise in Bitcoin. You cannot negate that. I mean, this guy is killing it recently, especially not recently. He's been killing for a long time.
He's already a fucking legend in the Bitcoin
universe. He's a legend, and the party hasn't even started, right?
Exactly.
But at the same time, I do think that he's missing a little bit of the point here on gold. And I think Dan Tapiero has a really good point on that, and I agree 100%. He's more involved with that than I am in terms of the pension funds, and it's absolutely true. We have conversations with those large allocators. There is certainly an interest in Bitcoin, no doubt, but there is a difficulty of the level of liquidity and the size of the market still, and in order for this flow. Yeah, I think you're going to see first, gold is the place where it accommodates that today. And I think will remain that way in the following years. Now, is it the fastest horse than gold? That's not a good comparison. One is a 10 whatever trillion-dollar market versus a few hundred billion. That's completely different. It's like comparing gold versus exploration industries in gold space. And obviously those, we have names that went up 600-700%. It's even more than Bitcoin. So,
Sure.
and I think there are opportunities in both ways. I'm not blind about it.
No, I think Bitcoin, mining stocks, and then precious metals will be the top performers in the next 10 years, and we will see who will be the fastest horse in the stable. But I think you should own everything. Yeah. Before I did this interview with you, I asked my followers on Twitter which questions they have for you, Guy. So I have 3 of them. Alejandro, for example, asked, do you think gold will be banned? We already answered this actually. Mara asked, she's worried about the ethical and environmental part of mining. What's your thought on it?
That's a real concern, but I think the whole world is moving more green, and I think a lot of that concern that she shares is shared by the community as a whole. And I think mining has changed significantly over the years and over the last decade, especially given that move, that I think it's also unavoidable. I think that, regardless of your political views, I think that seems to be the case, and we're probably going to be moving towards that, regardless if we want it or not. And that's going to be positive for copper, gold, silver, and some other commodities too. But answering her question, I think that is a concern, certainly, and it's something that we look at, and that's why it's important to marry a lot of things when you're buying a mining company, which is not only a good project. You really have to have something I learned, not recently, but learned, more recently over the years here, which is, a very good team is absolutely critical to have. And if you don't have that, it doesn't really matter how good the project really is. Those guys can burn capital, as they've showed throughout history, with doing very bad allocation of money here. So
yeah, definitely. Yeah.
Happens.
So Peter wants to know what happens do you expect deflation, and what happens with the price of silver and gold in a deflation? But we both know it will definitely go down. But yeah, do you expect deflation?
Well, I do think that deflationary bust like we had in March wouldn't be positive, but it's important. I do think it's possible in the shorter term. The longer it takes here, I think the probability for inflation is much higher. So, I think that there is a possibility. Maybe, I used to say that 6 months ago. Now we're up here, and so I think that maybe I would push it for another 6 months. There is a larger risk of deflation than inflation, maybe. Actually, I would take it back. I don't think that it's maybe 3 months. I would say deflation is a little larger than inflation. 6 months, I don't think so. I think inflation is a bigger risk than deflation, but that's just my view, because I think that's what's going to happen with the situation with the pandemic. Hopefully we'll be better by in a few months, and I think we're going to see start seeing the eyes of inflation very soon here next year. That might be a whole new theme for 2021, and will change completely the whole macro environment. So be ready for it and position yourself accordingly.
Yeah, definitely. Inflation will come. Inflation is coming, not winter is coming, but it's as well. So will Crescent Capital, actually, this is one question from another follower, create a retail product? Because right now you're just a hedge fund and only institutional investors can invest, but will you offer a retail product in the near future?
Well, we actually have those. So there's 5 products, but very quickly, there's 3 hedge funds. And the hedge funds are basically, so the global macro is where we invest all of our themes. So there's like the China play, the gold play, and also the shorts play, equity shorts. The long short, because of the nature as being only equities, it's only the buy gold and sell stocks idea is fully positioned. For people that don't believe in the China theme, fine. Long short is here for you to, if you want to buy gold and sell stocks. Well, if you don't believe that the markets will ever fall apart, there's certainly a large group of people that don't think that it's ever going to happen. That's fine. Well, then we have a precious metals fund that is focused only on precious metals. And then we, in 2019, launched a SMA, separate managed account, that is focused on precious metals. So it's a precious metals SMA, and the minimum investment is $25,000. So it's a much more retail investor product. We also have a large cap strategy that goes back to 1999. Very large. You can look at monthly history of that strategy, and it's also an SMA, but it's a little larger. So I think it's 100,000. I don't think it is 100,000 in minimum investment. So the most retail investor product we have would be the precious metals SMA. It's only focused on precious metals. Some of the names that we hold there is a little bigger than the precious metals fund, and the precious metals fund obviously allows us to use a lot of private placements, and that is the big difference here in this case here, where you get the free warrants and all those things. The beauty of negotiating those things. And unfortunately, the SMA, because of the nature of how it works and the structure of it, does not allow us to do that. So we have to buy it in the market. So we sometimes have to buy more liquid names. That's the difference. So the difference in performance can be pretty big, but it's still a retailing product that works really well and has been doing very well, and it's growing. It's not, it started with nothing, and it's now, I don't know, close to, I don't know, it's not big. It's like a 15 million, close to 20 million maybe.
Okay.
Small for us, but it's not bad for something we barely talk about, and it's a good product.
Tavi, my last question is, what is the sense of life for you? Something totally different.
Sense of life? In what sense are you asking?
What's the sense of life? What do you think? Why are you here? Why we are here? What's your sense of life? Is it to own gold, or to, I don't know, travel around the world, having kids?
Look, my sense of life is, I guess, that's a very hard question to answer.
Hard and deep, yeah.
But I'm going to say that my sense of life is, I am religious, but I'm also, putting that aside, I would say my sense of life is to be close to my family, to really grow with the people that matter to me in any part of my life. Regardless, when I was absolutely nothing in professionally speaking, and those are close to me, and regardless if it's my wife or my parents and sister and so forth. I am very close to my friends from people that have changed through our lives, but I'm still keep in touch with them. And I value that a lot, and I value sports too. So it's kind of like a mix of for me, sense of life is marrying those things of being close to the people that matter with also being in shape somewhat, athletic somewhat is what keeps me I guess healthy in general, and it's what keeps me waking up every day to do what I do as a portfolio manager. So
and you're doing a great job. You're doing definitely a great job. People who follow you will definitely tell you that you're doing an amazing job. And I have to mention, it was great talking to you. Definitely, it was amazing talking to you. I'm looking forward for a second time for next interview with you. Where can people learn more about you? Where can they follow you except on Twitter?
You can just look on Twitter at Tavi Costa is my handle there. Crescent.net. We have a lot of letters that we put out. And interviews. I think I have some interviews now on YouTube. If you just type my name there, Tavi Costa, you'll find plenty of stuff there that we do. You can find a lot of, we put out a lot of content. So hopefully we'll entertain you.
Yeah, definitely. Like I mentioned already, you have to follow Tavi on Twitter, and you check out the website of Crescent Capital. We will put all the links down in the show notes. So, hey, it was my pleasure talking to you finally after all these years, so to say. And I hope we will, in a new era, we will meet personal in the future. It would be amazing. I had so much fun and I learned a lot, and I hope the audience as well. Tavi, regards to Denver. Have a great time, and Merry Christmas and a Happy New Year, of course, and stay healthy.
Thanks, Mark. Thanks again. The feeling is mutual in terms of being a fan of your work. So thanks for having me. It's a big pleasure to be here. So I follow you as well for a while. So thanks for having me, and everyone watching, thanks, and look forward to keeping in touch. So have Merry Christmas, everyone. Thanks.
Thank you very much. I'm very grateful. Take care. Bye.